Welcome back, ladies and gentlemen. My name is Joshua Castillo. If you haven't seen my content before, I'm a value investor. I like to talk about companies on this channel as well as go through different value investors and things that they've done and interviews and things that I can summarize. And that's what we're going to do in today's video. If you couldn't already tell from the title, we're going to be taking a look at Seth Klarman. Now, Seth Klarman has been, just absolutely complimented by Warren Buffett, complimented by a ton of other value investors, and he wrote Margin of Safety. He is one of the all-time value investors as far as my book goes, and I think in history he'll probably go down as one of the legendary investors as well. Now, the thing that you need to know though about Seth Klarman is that while he is a value investor, he doesn't necessarily adhere to that very, Benjamin Graham style of investing. He's kind of modernized, and that's kind of, you read Margin of Safety, it's a modernized version of Benjamin Graham's book. He also very recently, I think the 7th edition of Graham and Dodd's security analysis, they did a lot of updates as well as some forewords in that. So with that being said, though, let's take a look at the Capital Allocators interview of Seth Klarman. I pulled out a couple of different notes that I wanted to go over in today's video, and I think that overall this will be really important. So there's going to be some sections I'm just going to listen along with you and then kind of talk about it after. So if that's something you're interested in, make sure to hit the like and subscribe down below, and let's dive right on into this. Now, here is the Capital Allocators on the screen right here. Go check out their channel. You can see here, there's a ton of different interviews with a lot of different investment professionals. And I think that it's probably important to get an idea of a bunch of different people, not just Seth Klarman. But as far as Seth Klarman goes, you can take a look and see what he is about here.
To smart money managers. And in the earliest days of Baupost, when I joined after I graduated in May of '82, I went to New York a bunch and met with money managers and thought about, well, would this one be good to hire? Would that one be good to hire? What's the playing field look like? It revealed a lot, but it also ultimately led to the decision that we would actually be better off managing the money ourselves.
What did it reveal?
Among other things, it revealed a great deal of groupthink. Everybody's favorite stocks were the same stocks. Everybody was buying Warner Brothers back then because they owned Atari. There was a lot of excitement around video games, as there has been excitement every few years about something different in the market. And then, shockingly to me, how few of the managers of money actually put their own money in the same product that they were expecting their clients to be in, and how important that alignment is. It's one of the main reasons Baupost didn't invest with any of those managers. We have realized that people talked a good game, but they didn't put their money where their mouth is, and why eating home cooking is such a foundational principle of Baupost, where still today the employees and their families are by far the largest client on a collective basis.
So taking a look at that first clip, there's two things I want to pull out of it. The first one being, when you are looking at a fund, so in a lot of cases, people's retirement funds and things like that, a lot of times it's ran by either a group or investment firm or some sort of hedge fund, or, people invest in different things. But ultimately, when people have a lot of wealth, or even if they're just accumulating wealth at a young age, they tend to put their money away into a fund, into an ETF, into something that is managed by someone else. They're not managing their own money most of the time, which is fine. But the thing is that a lot of times you have ETFs, you have hedge funds, you have different types of mutual funds where the people managing it, and I'm not talking about index funds, I'm talking about actual managed funds. A lot of times though, what's happened is now you manage this fund, or someone manages this fund. They don't have a lot of money put into this fund. They don't have a lot of money put in this ETF. So when they lose money on behalf of the shareholder, aka when they make a bad investment, their money doesn't really get touched. They still get a fee from you because your money's in there. So let's say you have a 1%, 2% fee on your money. If the investment portfolio goes down, it's still 2% of your assets. Even though it's, down a little bit, they still get 2% of your assets, 1% of your assets. So when there's no direct hit to the fund manager's pocketbook, why, it creates a lot of areas where there's a lot of ethics and morals that can get skewed. And I think that's something to pay attention to. Now, bringing that more so into the market and stock market and companies, Another thing that we see in companies in the market is that companies don't have leadership that have stock in the company. A lot of times you'll see board of directors, CEOs, CFOs, and, all sorts of different other, higher level executives in the company that don't even make up more than, 0.1% of a company's ownership, which when you have a CEO and board of directors that are supposed to be financially obligated to this company, they're supposed to be the shareholders of this company and kind of be the people that are running this company, and they don't have that many shares, that sets you up for a lot of hazard when it comes to, how they run the business. Because again, if they get a direct bonus payment, they have a big salary, they get a lot of benefits as far as, private jet, food, dinner, private security detail, driver, and all these different things, you, the shareholder, are bearing the cost of that. And if they make a move that's not in the shareholder's interest, but, they have obligation to the shareholder, but they can make a move that's not in your necessary interest, that can cause a lot of issues. So tying the kind of ownership to people's pocketbooks tends to make that much more of a factor when decisions are made. So there's a lot of companies that are owned by a one or two or three executives. Tesla is like a huge one that everyone knows about, that Elon Musk has a huge stake in. It's a huge amount of his wealth that's accumulated to today. So for him to make a bad move or not do anything, or let the competition come up on him, that creates a lot of issues. So it's interesting to me, though, as they try to use stock-based compensation as a way to kind of pitch this. But I think overall, when it comes to looking at management, both on the funds and on the stock side, you need to pay attention to who owns this company. And then the other thing that I wanted to mention as well, as far as the second point, is that when you have these fund managers, and again, you'll see this across Wall Street. This is not just, hedge fund managers or whatever. But a lot of times people have the big names. They have the Googles, they have the Metas, they have the Facebook, they have the Nvidia. They have every single name over the last, 10, 20, 30 years, from Meta to Facebook, Facebook to Meta, when it all switched. You have people that hold this. And the thing is that Meta back on October was obviously low for where it should be. But the thing is that you have Microsoft and Apple where they're not necessarily trading low. They're almost at 30 times PE in an environment that's not going to really support a 30 times PE multiple. Now, you can debate whether that multiple is correct or not and whether there should be a multiple revision, but that's not what I'm trying to argue. What I'm trying to tell you is that when you are buying the big, the big market, the top 10 stocks in the market, you're going to perform on average with the market. The thing is, though, is that these are carrying the market, like Nvidia. Nvidia is carrying the market right now. It's a big portion of the QQQ, big portion of the S&P 500, but it carries the market, obviously, when you have a company that has gone up so much like Nvidia has. But people buy into this, and funds buy into this when it's near the top, not necessarily when it's undervalued, like it probably could have been argued last October when the semis all hit a bottom. The thing is that when fund managers have one name that's running, everyone else is looking at the other fund managers saying, why don't you have that name in your portfolio? So you need to make sure that when you're looking at stuff that you don't get stuck too much in that way. As far as, when you put your portfolio together, you don't need to have the big names. You don't have to have the latest trend. Find companies that you like, find companies that are undervalued for what you think they're worth, and hold them for the long term, and actually recognize whether it's a compounder or if this is something that's just mispriced currently. And if it's just mispriced and it gets to full price for what you think it is, then go ahead and sell it unless there's some opportunities with that company still that you think changes the price in a positive manner.
In a variety of places. And then Buffett also, in that article, makes the observation that value investing is something not everybody is comfortable with, but that it's like an inoculation. When you get introduced to the approach, either it makes sense and you get it or you don't. And I felt like that inoculation had taken with me, that it made complete sense that people have trouble being patient and holding out for their best opportunities to show up and not just plunging in. Bill Ackman once said to me that value investing in a classical sense is like watching paint dry, but I bring a hair blower. I thought, well, that's a good definition of activism. And certainly I'm not one to just want to own stocks forever and sit on them forever. There are times when it actually can be challenging. In effect, the hard thing about investing in general is the market tells you you're wrong all the time. that the very reason that you can find a mispricing, the very reason that you can find a market inefficiency that causes a stock to go to a discount might well still apply after you own it, and it might go to a bigger discount. And that's not lost on Graham and Dodd. That's right there in security analysis. But the idea of that is perhaps there are ways you can speed it up. Maybe you can apply Bill Ackman's hairdryer into the process. One of the things that Baupost has done over the years, we follow the basic principles. We're looking for bargains, we're patient, we're disciplined, we're willing to say no a lot. As Warren Buffett says, we're not afraid to just leave the bat on our shoulder and not swing. But at times you do swing, and then you've got to be comfortable with some of the important elements of value investing. You've got to be comfortable that a bargain can become an even bigger bargain. And this is what resonated with me maybe the most. If you look to the market for feedback, the market might regularly say, you're an idiot, you bought it, now it's down, you don't know what you're doing. But the reality is that you've got to see that a little bit differently. You've got to see that as the market is now offering you a better bargain. Either you have confidence in yourself, or you believe in the market as giving you valuable information. And then, as Graham and Buffett say, if you look to the market for the answers, you're going to just be following popular opinion. But if you look to the market as a manic counterparty that sometimes sells you something at a big discount from what it's worth and other times pays you more than it's worth, now you're talking. Now you're going to be able to take advantage of the erratic market to profit as an investor.
Now, when it comes to a point like what he made there at the end, as far as, and again, I think a lot of people hear this, especially if you're on YouTube and you follow a lot of content on YouTube from value investors or just anyone that tends to put out stock videos, you'll hear the whole, buy the dip. If you believe in something and it dips down further, that's just a better bargain. I want to kind of, because I know what he's kind of alluding to, but one thing I want to mention is that there are times where you are wrong, and sometimes your own ego and wanting to make something work can get in the way of being, of realizing that you are wrong on an opportunity. Now, one of the things that I like to do, if I have a position that drops me 15, 20% over, either a few months or hopefully not a day, but over a few months usually is what happens. I like to take a look again at my thesis, say, okay, the quarter just came out. What changed? What didn't change? What is happening with the business? But as far as what he's saying, let's say you found, Berkshire Hathaway. It's dropped top tick to bottom tick 50% a couple of times. If you find a Berkshire Hathaway, it suddenly drops to the bottom tick 50%, and you see that and you go, okay, has anything really changed in the business? Has the fundamentals changed in the business? Is this truly something that I'm getting at a discount? That means that you can now buy more of this company. But again, you have to look at it through the lens of, is this true? Like, am I missing something? Is there a reason that it went down? And it's funny that he mentioned Bill Ackman and his analogy that he used, but Bill Ackman sort of does the same thing. If he finds a company and it goes down, or it's just selling for cheap, whether on a multiple basis or discounted cash flow or any sort of basis that he evaluates as cheap, he goes and looks, why is it cheap and is that justified? Because in a lot of cases, there's things that get marked down either on a multiple gets reversed, or you have the general stock price gets put back in place. Let's say the multiple stays, but the earnings went down. Now the stock price gets put back in place as as part of that multiple, and the stock price drops. Well, there's a reason for that. If the earnings are dipping, or if the earnings are projected to dip, let's say forecast came in lower than originally guided, things like that can change the outcome of a company. But there's a lot of cases like Chipotle, which Ackman owned, where he recognized that this is a short-term headwind, short-term problem, and if they turn this around, the gains on it are going to be huge, and he decided to invest as well as participate slightly in the business. So you have these opportunities when you invest to find companies where the short-term headwinds creates opportunities for you to get into a company very cheaply. If you look back at the banks back in the kind of spring to winter changeover, it was more or less the same. You can get banks at a really cheap price. I sold a put on Ally for 1 week and got basically 1% of my portfolio at no cost to me. The put expired completely worthless. which again, it's opportunities like that you have to stay ready for. You got to pay attention to. And I think that that's why if you watch the market, like if you watch CNBC or you watch, news channels or things like that, don't watch for the newest highlight, what's actually happening, the newest trend. Watch for opportunities that may pop up. Sometimes it's on the ticker. Sometimes it's you hear a little tidbit and you want to follow up on it more. But again, value investing is more about finding opportunities than it really is just, okay, this thing looks cheap, it must be cheap, therefore I'm going to buy it. Why is it cheap is the first question that you should be asking, and is that cheapness justified, or should it actually be worth, X amount versus what it's worth today?
I think the biggest part of it is probably pattern recognition, that you notice that patterns from the past have a way of repeating, not exactly, but with some similarity. You can find a fund that is in the process of liquidating its last asset. The pressures on them are, you better get that asset off the books. We don't want to carry it through another year end. And so all of a sudden, an asset that wouldn't normally be sold now needs to be sold with some degree of urgency. It could be something as simple as realizing that a bond or a loan is about to default or nearing default and might then trade at a steep enough discount, or that there's a restructuring opportunity. It might be that the market misperceives litigation and that either thinks the litigation is unimportant or thinks it's more important than it really is. So most investors are trained to analyze cash flow, but to guess legal probabilities, I don't think anybody's probably good at that. I'm not sure we're good at that, although we try. But I think there are factors that are just more important in the business than they've ever been, such as that. There are many, many of them that add up. And so I think that the combination of that leads to some playing fields that probably have fewer people playing on them that can lead to mispricings, as well as areas that maybe are more likely to be mispriced than others. So I think by following our nose, by looking for patterns, by pulling on threads of similarities, we end up with a pretty good portfolio of investments that are individually likely to be mispriced and collectively are reasonably diversified.
So what he had just mentioned there was something that I think is really important to recognize, and it's kind of an interesting topic because I don't think, as far as value investors go, I don't think it's something that gets mentioned a lot. It's stuff that it's definitely something that's alluded to oftentimes. You see, people who are outside of the sort of Warren Buffett and Charlie Munger grouping. You see a lot of them talk about it more often. And it's interesting to me to hear like Ted and Todd from Berkshire Hathaway. You have Seth Klarman, Bill Ackman, Monish Pabrai, Guy Spear, and all sorts of different value investors that mention that one of the most important things you can do is build that backlog of patterns. And the way that you do that is through reading, and not just reading to read, but reading 10Ks, reading 10Qs, reading analysis articles, reading research reports, reading industry reports, as well as reading books about value investors, about history, about the market, as well as different industries. There's a lot of times where one of the big ones that I've read this year was Chip Wars, that explained how the semiconductor market became what it is today. Well, to get that understanding, to kind of understand cycles and understand what you are looking at when you look at a semiconductor company, having that background in your brain helps build these pattern recognitions. So, and part of it too is getting your reps. So if you go through, let's say 110Ks in a year, or you read through, however many analysis reports in a year, what's going to end up happening is, if you're actually serious about investing, you'll read 110Ks, you'll read 1,010Ks. You probably won't even invest in 100 of those companies. You'll probably invest maybe 50 at best, probably 20, 25, or at the very least, you'll find 20, 25 opportunities that you think are pretty good. And the thing is you might have to wait for the valuation to come down or wait for an opportunity to buy. But overall, what happens is the more reps you do, the more you value companies, the more you look into industries that you're interested in and kind of expand your circle of competence, but don't go outside of it. You'll have opportunities to actually recognize patterns. So let's say you're in this chip cycle and you're trying to track where it's at. Well, you can look back years ago and say, okay, the chip cycle bottomed at this point, and are we near this point, or what point in this cycle are we in? Are we building a bunch of capacity that's not going to get used and end up being overcapitalized, over capacity just in general, and have companies that go under that don't need these chips anymore, and all of a sudden our inventory is completely marked way sky high, and we're going to have to get rid of some of this stuff. That's kind of the thing you want to look for, is opportunities where, is this balance sheet making sense? If you have, a credit cycle that's happening, like we're seeing right now in the mortgage space, and we have interest rates going up. Well, what happened in the past when the Fed raised rates? The only way you're going to understand that is if you read books about monetary policy, if you read books about the housing market, if you read books about industries and how different credit and how different equities are impacted by different sets of rates, and whether it's high or low rates, and how that would work. So it's really interesting to me that he mentioned this. I feel like a lot of value investors talk about it, but no one talks about it in terms of pattern recognition. And I think that when you think of why they read so much, this is exactly why. It's about getting those reps in, understanding this happened in the past. Why is it going to happen now? And even if you listen to Ray Dalio, he repeats a lot of the things that he's read, and a lot of it has to do with the fact history doesn't repeat exactly, but it does rhyme. So looking into the past is a great way to see things that are coming in the future, and as well as analyze things that are here today. And then this is going to be the last clip that I have. It'll be sort of a long clip, but I think that overall it's pretty important. Again, I'm sorry that these clips tend to be a little bit longer, but I think that it's important to kind of get the whole idea, so that way we can analyze it together and kind of summarize it together.
Opportunities, pattern recognition, canvassing wide. What does a fully vetted process at Baupost look like, from seeing the opportunity to doing the deep dive to when you're ready to make an investment?
It can be days and it could be years. That depends on the nature of the opportunity. I like to say that a big enough discount maybe offsets a lack of the deepest possible knowledge. Sometimes there's chaos in the markets and you want to move quickly. On the other hand, anybody that looks at the price and says, wow, that stock has fallen 20% in the last couple of days, to think that happened for no reason would also be incredibly naive. So I think that investors need to move with a degree of alacrity, because opportunities don't last forever. But they also need to do everything with a great deal of humility, because the market doesn't just give away free money. There are a lot of smart people. Sellers might know as much or more than you. They, after all, have owned it for a period of time and you haven't. So you ought to really spend enough time to get comfortable to at least make sure you're not the patsy at the table in the way Warren Buffett would describe it. We do a ton of deep work. We dig deep into company financials. We look back a number of years. We always ask ourselves about not just what's the reported number, but what's really going on. What's the free cash flow? What are the margins doing? Have they gotten better? Have they gotten worse? Is this management doing a good job? Are there missed opportunities? Or are they stretching to put up good numbers that might go away? So we're digging things that have changed over the course of my career. When I started, there were no expert networks to call. You had to figure out your own and maybe figure out who might know something about this business, or piece it together talking to experts on certain part of the business. So I would argue for sure there's way more information available. We all have more information available at no cost or low cost at our fingertips than people in the most serious investment positions had 20 or 30 years ago. But that said, information's only so valuable also because it's what you do with it. It's having a differentiated view about it. We have then active internal debates. The teams meet as pods, which tends to be a partner and a more senior and a more junior analyst all together. That's an approximation, but that's what it looks like. When they're ready to make a recommendation, they may run it by another pod just to say, hey, does this sound crazy? We have our analysts meet once a week at lunch. Anybody who's around and wants to meet. The partners don't attend that. So it's a free space for analysts to be running things by each other and not feel like partners going to hear them, or they might judge them for being naive or having a silly idea. So I think that's really important for people's development. When the team's ready to pitch the idea, they run it by me. They run it by our president, Jim Mooney, as well, usually at once in the same meeting. If it's a public idea, we have our traders in the room who can shed insight into how the thing is trading or any particular thoughts about what's going on in the market at the moment on that name. We reach a decision often in an hour. Sometimes we don't reach a decision and we agree to reconvene, or we agree that it's interesting but not at the current price. Other times we'll meet, we'll agree, we'll buy it. And then in days we're meeting again because the prices drop further and it's now an even better bargain. And do we want to own more? Part of my nature is these things churn in my head. So sometimes I'll wake up after a meeting the next morning and think, I forgot to ask one question, or there's a risk I hadn't thought about that now I'm thinking about. And so we'll reconvene. It probably drives my people a little crazy, but I always think protecting the client's capital is more important than whether I drive somebody a little crazy. So we are constantly reconvening if it moves closer to our price target. Is this a good sale? When should we get out? Do we sell part of it? How should we think about that? If it falls, should we buy more? How big should it be? If something else gets more interesting, should we keep holding it, or is this new thing even more attractive? There are two things that are limited in investing, two constraints on every investor. One is capital and the other is time. And they're both really important. So if something you own falls, sometimes you'll trade out of it even though you don't like it any less than you did. You just like something new that came along more. Those kinds of conversations, I think, are extraordinarily helpful in optimizing a portfolio.
So ending on that note and kind of, he kind of explained the process that Baupost goes through and kind of what is so important as far as the process goes. So doing a deep dive is one of the most important things that you need to do on a company. Do you understand it? If you get, page 2 or 3 of the 10K and you're just like, I don't get it and I don't understand this business, it's time to move on. And 2, sometimes you will read something, sometimes you'll go through a 10K. It may be a good company. Today's price might not be the right price. Again, you can set an alert. There's tons of different apps, tons of different websites where you can set an alert and you'll get pinged as soon as it hits that price. Or you can set an open order to buy and just set it at that price. If it goes down to that price, it'll fill at that price. Now, one of the things, though, that I wanted to mention as far as everything goes is kind of walking through, what he mentioned. So you have time and you have capital. Obviously, the capital is, it's an obvious one because you only have a certain amount of money that you're, investing with. You only have a certain amount that you can put into each company. So you can't just get unlimited positions. So then it comes down to, what is my opportunities currently? Do I have better opportunities? And this is something that I have struggled with in my own portfolio. I have way too much cash and I know that, but it's struggling of, do I put more into the current positions or do I look for more positions and make those positions bigger? And I would love to get to the point where either I'm fully into companies or I, have a tiny bit of cash and not so much at where I'm at today as far as my allocation. But I'm looking for companies right now, trying to build out that portfolio still. So I'm okay with where it's at right now, but I would like to get to that point where I'm deciding on companies and what to stay and what needs to go rather than, I have so much cash that I don't need to get rid of the other companies currently. The other thing that he had mentioned too was time. So time is one of the most important things because, an opportunity can look good today. As time goes on, it could deteriorate or it could look even better. So, and again, part of that too is you may have a company, because again, if you do I keep saying this, but if you do a discounted cash flow, you're getting an approximate of what you think this company is worth. It's never an exact number. You're never going to be 100% right. You may have a ballpark of where it might be. And if you run like a Monte Carlo and like do a true regression of every single possible outcome, you may get like a range of outcomes that it could possibly land in, which is fine. But what you really need is a sort of level where you feel comfortable investing into a company where if you're right, you're going to make a lot of money. If you're wrong, you might not lose any money, or you might lose a tiny bit of money. You don't want this like it's going to 90% up or negative 90% down and there's no in between, because honestly, the value on that, you're going to lose a lot more money over time if you do that, especially because a lot of times people make that position sizing way too much for their portfolio. I'm not going to go over, he did talk about position sizing. I think it's at the 47th minute. He did talk about that a little bit. I'm not going to go into it in today's video, but let me know what you guys think down below. Go watch the interview. It's a really good interview. It's not too long, hour 33. It's, you could easily listen to that at work, at school, while you're driving. It's a pretty easy interview. And obviously he's not talking about anything too complex. So if you're new to the market, new to getting comfortable value investing, definitely check out Seth Klarman. He's done a bunch of other interviews as well. I summarized some of his points last year, and unfortunately, a Harvard business locked that interview, so I don't have a copy of it, but I have the summary points that you can see in the video. Now, one last thing, there is an actual CNBC interview that came out recently for Seth Klarman. I didn't want to show it here because oftentimes CNBC doesn't like when you use their videos, but I believe it's on the pro side of CNBC. So if you want to see the full interview with him, you can go check it out there. And I'm going to do some other quarterly updates as well as a analysis on probably 1 or 2 companies in the coming weeks. So stay tuned for that. With that being said, thank you all for joining me today. I hope you enjoyed the video. Hope you enjoyed the summary. Have a great day and happy investing.